Hi, everyone. It's the Catholic CEO, Henry Kutarna. Welcome to this Catholic Business Wisdom Series topic today on investability. What makes your business investable? I'm going to cover 6 different topics in rapid fashion in the way we're doing these series. I'm going to speak first about the pitch deck, which is the way you tell your story. Number 2, I'm going to talk about the types of investments that are out there. Number 3, I'm going to talk about the forms of investments that are out there. And then number 4, I'm going to talk about the structure of various investments and various things you must do to become really investable. And then number 5, I'm going to speak about valuation, which is the fundamental question that you will always face when you try to take other people's money. And then finally, number 6, I'm going to close with thinking like an investor. So let's dive in to the very first topic, the pitch deck. The pitch deck is a slide deck that shows, preferably in about 10 minutes, the answer to 12 key questions. And you can check with me if you'd like to see a copy of these. The 12 key questions lay out the way the mind of the investor works, whether it's your bank, a line of credit, a private angel investor, a VC, a venture capital firm, private equity, or whoever. The pitch deck tells your story. It answers 12 key questions in the way the mind of the investor works, but it also answers completely the 12 key questions that are the entire set of questions that most people will ask initially. The purpose of a pitch deck is to get you the next meeting. It's not to get you the investment. If you can do a due diligence meeting subsequent to your pitch, and have 2-3 hour discussion, that's wonderful. But initially, because investors have many choices, they want to see multiple deal flow, they will only give you a few minutes, 10 minutes, whether you phone them, show them a pitch deck on a call, a video call, or send them an email with a set of slides, or even an audio track. You're going to have, the challenge will be to tell your story. And there's a way to do it effectively. There's a way to do it in an exciting fashion that doesn't oversell. The thing is, you have to be careful not to oversell, because if you oversell, everybody knows then that you're a promoter, and they will actually discount your deal as a serious proposition if you oversell it. So that's a little bit about the pitch deck. Let's move to the second topic, which is the types of investments and the types of businesses that seek investments. Here are some examples. We have some category of businesses called lifestyle businesses. These are businesses that you set up that are intended to provide you a job for life, or dividend income, or income for a long time. They're not high growth companies that rapidly expand and take you to multiples where you're going to have a high valuation. There are rapid exit businesses. Often these are software businesses where you quickly scale up, build a business, go from minimum viable product to full commercial status, and you exit within 2 to 3 years. There are categories of businesses like that, and you should be thinking about all of these to see where you fit. There is the IPO model, the initial public offering, where a business starts up and grows, but then it goes public on a stock exchange to get greater liquidity, a much broader base of investors, and the possibility then of what they call a liquidity event, where somebody comes in, invests, buys shares, and then can sell those shares at any time. And so it's a mechanism for not only getting greater capital and a greater number of investors, but it allows, as they say, liquidity. It allows you to get out of your investment. There are companies that are organic growth companies. They are set up, they start, and they grow, but they grow at a very moderate pace organically. In other words, without major injections of capital, maybe with ordinary line of credit financing and ordinary growth in products and in markets. There are companies that seek investment in multiple rounds. And so you will often hear Series A, Series B, venture capital, angel financing, all these different stages of investment. And your company, if it's set up for multiple rounds of investment, will take capital in and achieve a certain set of milestones. And then when it has proven that it can achieve those milestones, the next round of capital will be waiting for it. Now, this is a laborious process. You have to be working to bring each of the subsequent rounds into the picture with sufficient time for them to make a decision and to see how your company's operating. But you may be setting yourself up for multiple rounds of investment. There are what you call life cycle businesses, where you develop a product and you put it to market, but it has a natural life cycle. It may be something that is a one-time thing. I'm thinking of some examples where a certain product will not have multiple customers. There won't be a kind of a lifetime value of a customer aspect to it. It'll just be a one-shot deal. And you might then, for example, it might be a forestry business or a nursery of some kind, plants or trees, where you basically invest in that business and it has a single stock of plants or trees, and once sold, it's done. And so sometimes investors come in, but it's a life cycle business. In other words, it has a natural start and a natural end to it. So these are some brief examples of the types of investments and the types of companies. I'm going to switch now to the third topic, which is the forms of investment. And this is really a set of the kind of investors that are out there perhaps interested in your business. You will certainly have, as you found a business, if you're the founder and you start a business, you're doing an initial startup, early stage company, you're going to have what we call founder investments and friends and family investments. And that's the initial money that you put in. Whether you bootstrap it, use your pension funds, take out equity from your home, from your savings, what have you. Your usual first form of investment is the early round founders and friends and family. The second group that comes in usually after that, once the setup is started and you are starting to produce maybe a minimum viable product, or you have an initial service offering out there and you're starting to get some sales, you will attract angel investors. And these are people that take the highest risk because they come in earliest, right after the founders. But they are also people who have talent and ability. They also respect the entrepreneurial spirit greatly, and they're interested in working side by side with you, rolling up their sleeves and digging in with you. That's why they're called angel investors. Later, you might have several rounds of venture capital. Venture capital comes in at a much higher valuation, maybe 10 million plus, and a venture capital firm is a pool of capital, much more aggressive in its approach, less likely to work with you and work side by side with you, but more interested in accelerating your growth with lots of capital and then moving you towards an early exit. You might also have private equity firms that will buy up a business and maybe create a collection of businesses that have similar approach, and they will aggressively work, PE firms, private equity, they will aggressively work to trim the business, cut costs, shed assets that are not essential to the main focus, and they will be quite not only aggressive but quick about it. They will try to turn this around and sell off the pieces of the business, and so you will want to be very cautious about that. Certainly bank financing, at some point banks will be interested in you. Banks will not finance an initial startup, but they may come in when you have a year or two of good solid revenue growth. And there are different kinds of banks. There are the banks that are perhaps stage banks, where they come in later on, or there might be banks that want to take a higher level of risk. They might be subsidizing you with forgivable loans or favorable terms, that sort of thing. And so there's quite a wide range of banks. Other forms of financing include what we call non-dilutive financing. That would be grants and credits, local business rehabilitation zones or business improvement districts. In most major cities, you'll have those. You might have in the US the SBA loans. You might have in the Canadian system BDC, the Business Development Bank, or the Community Futures Program. You may also have grants from technology organizations or government bodies, provincial and state, and certainly national governments that want to promote the growth of certain industries, certain sectors of the economy, and they usually have programs available that help you develop your technology or build your sales and marketing team or create marketing support and help so that you can penetrate markets quickly and use the expertise of others who have done this before, and so you don't have to sort of learn it on your own and waste a lot of valuable time. So these are the typical forms of investment. The IPO that I mentioned a few minutes ago is also one of these where you could go to the public stock markets. It's pretty rare to go to a stock market with a company that has zero revenue, but it has happened, especially in the technology era, when you have companies that are attractive because they will attract many eyeballs, let's say, but they don't yet have revenue. They're a massive project. Some of the AI projects in the very beginning attracted multiple tens of millions of dollars of capital, but had no revenue because the product wasn't finished. The product required a huge amount of effort to finish it off and a huge amount of money. And so, you've got a different kind of mindset about these things. So those are some of the earliest forms of investment. Going to moving quickly here, number 4, the structure of various parts of becoming investable. What do you have to make sure you at hand so that you can show them and demonstrate to your potential investors that you know what you're talking about and that you have the information that's needed. So you'll have, for example, what we call the cap table, the capitalization table. It's a list of all the shareholders, including all the types of shares they hold with all of the rights and responsibilities, the stock options, the warrants. There's terminology like diluted, fully diluted, things that you can learn about in detail. But you can have a cap table. You will have to have a cap table to demonstrate how much capital and in what ways it is distributed among your shareholders. You'll have the different kinds of shares. You'll have common shares and preferred shares and various different types of shares, each with different responsibilities and different rights. It's a complicated topic. We'll have a separate topic on this later on, but the point is there are many, many different kinds of shares with different rights and different responsibilities, and you can either have a single type of share in your business, or you could have multiple share types for different reasons. It's a very complicated topic, but we'll cover that, like I say, in the future. You will have debt financing, which means you're borrowing other people's money, whether it's from the bank or private investors. You will have equity financing, where people actually buy an interest in your company. They buy shares. They take a percentage interest with you in your company. You will offer sometimes with shares what we call options and warrants. These are rights to do certain things like buy additional shares at a certain strike price, that is, at a certain fixed price, or when certain circumstances happen, like when you achieve a certain milestone, you may be able to exercise the right to buy some further shares. You'll have to have a minute book which chronicles all of your activities in the business and lays it out step by step, date by date, point by point, so that somebody looking at your business for an investment can look at that and see that you have faithfully represented all of the activities of your business accurately and honestly with complete list. It's a very important thing. You'll have also a USA, a unanimous shareholders agreement, which spells out the way that all the shareholders will do business. How will they vote? What happens if somebody dies or is divorced or is somehow incapacitated and cannot any longer act, or if somebody wants to leave, somebody wants to buy shares, somebody wants to sell their shares. The USA is an important document. I have a template that I could send you, a 2-pager on all of the questions that you need to ask about what goes into a USA. You will have corporate structures. You might be setting up a holdco, a holding company, or an opco, an operating company. You might be setting up different jurisdictions. Nevada Corps and Delaware Corps are different, very favorable to business. States that provide services and an orientation with your organizational structure that is favorable to business. You will have intellectual property to protect. You might have software. You might have a patent. You'll certainly have copyright and trademark and patent considerations in the kind of business that you're operating. You will have mechanisms to take care of shareholders in case you have a down round where you're selling shares in the next round of capital, but perhaps at a lower price than the previous round. And so we call those anti-dilution And they are very complicated topics, but I'm just mentioning these because you need to be aware of the depth and breadth and range of things that you should be familiar with. You need to be familiar with the concept of dilution, which is what happens when additional money comes into your company. What happens to the valuation? What happens to the value of your shares when new money comes in? You get diluted. If somebody else brings in money and they buy a certain percentage of the company, your percentage of the company may drop, not necessarily, but it might drop. And if it does, you might be owning, a smaller value per share, but you may have many more shares, and so you might have a smaller percentage of a pie, and you might have a bigger percentage of a pie later on as it grows. So lots of complicated questions that we could get into, and we will in the future. I'm going to switch to the valuation topic now, where we have, generally speaking, 4 ways to evaluate a company. And when you're taking anybody's money, including the bank, you're going to enter into a negotiation on valuation, because they're going to want to give you money or buy equity shares in your business on the basis of how much your business is worth. And so we need to consider, from the very first days when we are a startup, when there's actually zero valuation, right? At the very beginning, you have no revenue, no product, maybe even no intellectual property. What's it worth? Well, it's worth 0. But as you build a business and as it grows in revenue and markets and products, your valuation will climb. So there are 4 main ways to evaluate a business. 1, just like your house sales, you'll have comparable sales of typical businesses or similar businesses, let's say. So comp sales, comparable sales. Secondly, you'll have replacement value. If you've run a business for 3-4 years and you're gradually starting, one way to evaluate that business, the second way, is actually to think about all the money and the time and the dollars and the hours put in to recreate it from scratch to the point where it is today. So that's the replacement value method. You'll have the third method will be the net present value of a future stream of income. Long, complicated process, but what it is doing is it's taking forecasted revenue for the next 3 to 5 years, let's say, and bringing that back to a present value, because a stream of income down into the future isn't worth the same as money in the hand today. So you do this net present value calculation of the future stream of income. It's a way of evaluating your business. And the fourth way is to evaluate the business on multiples of existing income. And the concept is called EBITDA, EBITDA. And EBITDA is earnings before interest, taxes, depreciation, and amortization. It seems complicated, but it's a very simple accounting concept, and you can learn it, and I can help you to figure it out, where you take multiples. So, for example, a common way to evaluate a manufacturing business is 3 to 5 times EBITDA. So you take this financial statement number called EBITDA, and you multiply it by 3 or by 5 or somewhere in between, and that gives you a sense of the valuation of the business. So valuation, these are the 4 main methods. There are other methods, but they're all variations of these methods. The key thing to remember about valuation, it's a negotiation. What's in your mind and the mind of your investor or your purchaser or someone who wants to take your company into and exit you, there is a negotiation, because your perception of the value, you might be using all these 4 methods. So will the purchaser, so will the person who wants to invest in your business. And they might come to a different answer than you do, because they may see risk differently than you do. They may not believe in your business like you do, and therefore it is a negotiation. That's the complexity of valuation. It's a great topic. It's lots of fun, actually, because you can enhance the value of your business on a day-to-day basis by paying attention to certain factors. And once again, we can talk about that in the future. Finally, section 6, thinking like an investor. When you are running a business and you want to take in investment or even go to the bank for financing or sell shares or borrow money or even go public, you'll need to think like an investor. So you'll learn a term like a term sheet, which is a document, one-pager usually, that lists all the terms of the money coming in, what the rights are, the schedule, when, how much, under what conditions. You'll sign an NDA, a non-disclosure agreement, which is an agreement promising confidentiality and privacy, and that you will not reveal the information. And these have the force of law because they are contracts. You will have what you call a deal room or a due diligence room, where you will have a private website location. Could be hard copy files, but not as easy to deal with because you can spread it around then, which might not be in your best interest. But if you have an online system that is password protected and so on, you have all these documents, and I can send you a list of all the types of documents that show up in a due diligence document, so that when someone is conducting due diligence, they can see all the information about your business. And that includes your patents, your trademarks, your white papers, your technology, your contracts, your org chart, your job descriptions, your list of employees, revenue, forecasts, financial statements from 3 or 4 or 5 years back, and projections forward into the future. All of the information that helps the investor make a decision. So you can see, in summary, very short form process here. And so the topic of investability, it's worth a whole semester in the MBA school, but I compressed it into 20 minutes for you to suggest that becoming investable means paying attention to a lot of factors. It doesn't mean randomly operating your business or believing or pretending that it's got some value. You're going to have to become quite mechanical and quite technologically sharp in terms of accounting or valuation or forecasting, or even portraying the value of your business. There are a lot of mathematical calculations involved and lots of actions that you must take on a regular basis to create an investability feature, and that makes your business more valuable. So there we have it. It's a summary of what makes you investable. We have a short course that I can offer you on investability, and I certainly will be able to talk with you as you wish about this. Thanks again for being here. It's the Catholic CEO, Henry Kutarna, and I'll see you next time.